Heiken Ashi candlesticks are so popular among new and professional traders. Everyone loves them, and there is a strong reason for that. They filter out a lot of market noise so that the price chart can look much cleaner. However, only a small percentage of traders know how to utilize Heiken Ashi properly. So in this video, I will explain how these candlesticks actually work and show you some of the best strategies with Heiken Ashi for crypto, stocks and forex that will make you tons of profits long term. This video will also be extremely useful for those who are struggling with finding the best trade exits. Let's face it, the majority of traders don't really know exactly when to exit a profitable trade without leaving money on the table. Because more often than not, you encounter the scenario where you enter the trade, the price goes in your direction, your take profit target gets triggered, and the trend continues to go in your favor. And now you're feeling bad for making only 10% of what you could have really made if you had not exited the trade that early. And let me tell you something, such strategy exists. It's called Heiken Ashi exit strategy, and I'm going to teach you how to use it in this video. Okay, so first let's answer the question, what is the Heiken Ashi technique? See, the Heiken Ashi candlestick averages price data to create a Japanese candlestick chart that filters out market noise. Heiken Ashi charts developed by Munehisa Homa in 1700s share some characteristic with standard candlestick charts but differ based on the values used to create each candle. Instead of using the open, high, low and close like standard candlestick charts, the Heiken Ashi technique uses a modified formula based on 2-period averages. This gives the chart a smoother appearance, making it easier to spot trends and reversals, but also obscures gaps and some price data. Okay, so here's the formula for calculating the Heiken Ashi close. It's basically calculated by adding the current open, high, low and close prices and dividing the amount by 4. For the Heiken Ashi open, the formula is different. It's calculated by summing the Heiken Ashi open and the Heiken Ashi close from the previous candlestick and dividing this amount by 2. That's the reason the next Heiken Ashi candlestick will always open at the middle of the body of the previous Heiken Ashi candlestick. The Heiken Ashi high and lows aren't any different from the regular Japanese candlesticks. So what does Heiken Ashi actually tell us? The Heiken Ashi technique is used by technical traders to identify a given trend more easily. Hollow white or green candles with no lower shadows are used to signal a strong uptrend, while filled black or red candles with no upper shadow are used to identify a strong downtrend. Reversal candlesticks using the Heiken Ashi technique are similar to traditional candlestick reversal patterns. There are no gaps on a Heiken Ashi chart as the current candle is calculated using information from the previous candle. Because the Heiken Ashi technique smooths price information over 2 periods, it makes trends, price patterns and reversal points easier to spot. Candles on a traditional candlestick chart frequently change from up to down, which can make them difficult to interpret. Heiken Ashi charts typically have more consecutive colored candles, helping traders to identify past price movements easily. The Heiken Ashi technique reduces false trading signals in sideways and choppy markets to help traders avoid placing trades during these times. Okay, let me now actually show you a really simple strategy you can use for trading with Heiken Ashi. For this strategy, you will only need 2 exponential moving averages. The first EMA is going to be set at the length of 50. The second one is going to be set at 200. And the reason we have these EMAs on our chart is to identify the trend direction. If the price action is closed above the EMAs and the 50 EMA is above the 200, we are officially in an uptrend. Exactly opposite is true for a downtrend. And the conditions for entering a long trade are simple. First, we're waiting for a golden cross where the 50 EMA crosses above the 200, and then we're simply waiting for a Heiken Ashi candlestick to pull back into 50 EMA. This means that the body of the candlestick has to actually touch the moving average. And once you have that, you're going to be waiting for a bullish Heiken Ashi candlestick with no lower shadow. And once you have these conditions met, you can safely enter a long position. Your stop loss will be set at the recent swing low. For this particular strategy, you can use a fixed risk-reward ratio, or you can exit the trade as soon as you have a signal from the Heiken Ashi. I'm going to teach you how to use the second method in a moment, but for now, let's actually target 2 times the risk. As you can see, this strategy is fairly simple yet really profitable, and as you can see, this happens over and over again. Of course, you will encounter losing trades, but as we all know, the losses are the part of the game. It's all about how we manage our risk. Exactly opposite is true for short positions. First, we need to have a dead cross where the 50 EMA crosses the 200 EMA downwards. Then the price action has to make a pullback into the 50 EMA. The body of the Heiken Ashi candlestick has to touch the line. We see this signal wouldn't be valid. And once you have a red Heiken Ashi candle with no upper shadow formed, you can safely enter a short position. You can set your stop loss at the recent swing high, and let's target 2 times the risk. And again, this thing happens over and over again. We can see that the win rate for the strategy can get up to 60 or 70%. Of course, you can modify the strategy and add some other indicators to the chart to eliminate these losses. For that, I would recommend adding a good volume indicator to the chart. Okay, now let's actually understand how we can use Heiken Ashi for trade exits. And this technique can make you so much money, especially at the times when the market is trending. So for example, we have a setup to go short. Now, instead of capping our profits, we will exit a winning trade as soon as we have 2 consecutive bullish Heiken Ashi candlesticks formed on a chart. We see the trade was running in profit right away. If let's say we had an exit signal but the trade wasn't being profitable, we would simply ignore that signal. We see that 1 bullish Heiken Ashi candlestick formed is not enough to make us think that the trend is actually reversing and we should exit the position. So we should definitely have at least 2 of them to make such a decision. Exactly opposite is true for long trades. For example, we had a signal to go long. And if the trade is running in profit, we're going to close the position as soon as we have 2 consecutive bearish Heiken Ashi candlesticks formed on a chart. We see the risk reward can get up to 5.5 to 1. You can also try a slightly different approach where you would basically exit the trade once you have 2 consecutive bullish Heiken Ashi candlesticks with no lower shadows. And by using this technique, you don't really feel bad for exiting the trade too early. We see that you're almost catching the whole trend. Okay traders, I think that's going to be it for this video. Don't forget to smash the like button if you found it useful. By the way, if you're new to TradeIQ, check out my best indicator strategy on the channel. I'm going to leave a link to that video in the description below.